Most traders don't lose because they're bad at trading. They lose because they're excellent at training the wrong skill. You've been told, improve your entries, find better setups, predict price more accurately. That advice feels logical. It also quietly destroys accounts. Because markets don't reward prediction, they punish it. And in a few minutes, you'll see why getting better at predicting price is often the fastest way to stay broke, even when you're doing everything right. Let's define the frustration you feel. You studied price action. You understand support and resistance. You wait for confirmation. You manage risk, at least on paper. Yet price still does this weird thing. It moves exactly where your stop is, then runs in your direction, over and over and over again. So you assume the problem is accuracy. I need better timing. I entered too early. My setup wasn't clean enough. But what if accuracy was never the issue? What if the market doesn't care how good your setup looks, only how you behave once money is at risk? That's what this video fixes. By the end, you'll understand what skill retail traders obsess over, what skill markets actually reward, and how to retrain yourself so price stops feeling personal. Stay with me, because the next part usually hurts egos. The skill you're training without realizing it. Every time you open a chart, your brain is training something. Most traders think they're training market understanding. What they're actually training is pattern prediction. Look closely at your routine. You scan charts, you mark levels, you wait for confirmation candles. You imagine where price will go next. Your brain gets dopamine from anticipation. This trains one core habit: trying to be right about the future. Here's the problem. Markets are not exams. There's no prize for correct guesses. Markets are risk transfer mechanisms. They reward who manages uncertainty best, who controls downside, who survives randomness. Prediction is optional. Execution is mandatory. Stop and think. Why do casinos make money even though individual outcomes are unpredictable? Because they don't need to be right on each spin. They control risk structure. Most traders do the opposite. Prediction feels productive. You feel analytical. You feel prepared. You feel ahead of the market. But prediction creates 3 silent traps. Trap 1. Emotional attachment. Once you predict, you want to be right. Your trade becomes an opinion, not a position. Trap 2. Late flexibility. When price gives new information, you ignore it. Why? Because it conflicts with your prediction. Trap 3. Overconfidence from random wins. A few good predictions convince you that, I've cracked it. But markets punish certainty. The more confident the crowd, the more attractive their liquidity becomes. Here's the uncomfortable truth. The market doesn't move to reward correct analysis. It moves to find liquidity. And prediction crowds liquidity in obvious places. Which brings us to the next point. Forget charts for a moment. Think structurally. Large players cannot enter or exit positions quietly. They need counterparties. Where do counterparties exist? Above obvious highs, below obvious lows, around retail confirmation points. That's where stops live. That's where emotional traders react. So when price randomly spikes into your stop, it's not randomness, it's participation. Retail traders train prediction. Institutions exploit behavior. Here's the twist most people miss. Institutions don't care if price goes up or down short term. They care if enough volume trades at favorable prices. Prediction doesn't help you here. Decision-making does. And this is where most traders short-circuit. Profitable traders don't ask, where will price go? They ask, what decision does this information allow me to make with defined risk? They train 4 skills instead of prediction. 1. Risk calibration. How much can I lose here without emotional damage? 2. Context, reading. Is price accepting or rejecting this area? 3. Behavioral awareness. Who is trapped here, buyers or sellers? 4. Rule execution. Can I follow my plan even if I feel stupid doing it? Here's the part nobody likes. A trader with a 40% win rate and elite execution will outperform a trader with a 65% win rate and poor discipline. Because markets don't care about win rate. They care about distribution of outcomes. Prediction doesn't control that. Process does. And the weird part is, once you stop predicting, price starts making more sense. Let's ground this. Imagine two traders. Trader A, the predictor, waits for perfect setups, enters only when everything aligns, moves stops when price almost works, takes profits early to lock wins, win rate 62%, account slowly bleeding. Trader B, the executor, trades defined contexts, accepts small losses without adjustment, lets winners play out mechanically, stops trading after rule violations, win rate 41%, account compounding. Why? Trader A trains being right. Trader B trains risk behavior. Trader A reacts emotionally to outcomes. Trader B reacts structurally to information. Markets reward Trader B because losses are capped, winners are asymmetric, decisions are repeatable. This isn't theory. This is how professional risk desks operate. Prediction is cheap, execution is rare. And now comes the most important shift. Here's a simple framework to replace prediction with decision-making. Step 1. Pre-trade question. Before any trade, answer only this. If this is wrong, how wrong am I willing to be? If you can't answer, don't trade. Step 2. Context check, not setup. Ask, is price expanding or compressing? Who is likely trapped here? Where is forced behavior likely to occur? If price is slow and balanced, prediction fails. If price is imbalanced, decisions matter. Step 3. If-then rules create non-negotiables. If price closes back inside the range, then exit. If volatility expands in my favor, then trail mechanically. If I feel urgency, then do nothing. This removes opinion. Step 4. Post-trade review, the right way. Do not ask, was I right? Ask, did I follow risk rules? Did I violate size? Did I interfere emotionally? You're not training accuracy, you're training behavior under uncertainty. That's the edge. Common traps and quick fixes. Trap. 1. Chasing confirmation. Fix. Enter on invalidation, not excitement. Trap. 2. Over-optimizing entries. Fix. Stop adjusting entries. Adjust risk exposure instead. Trap 3. Revenge trading after good analysis. Fix. Analysis doesn't entitle you to profit. Execution earns it. Trap 4. Measuring skill by win rate. Fix. Measure. Drawdown control. Rule adherence. Emotional neutrality. Trap 5. Thinking losses mean you're wrong. Fix. Losses mean uncertainty expressed itself. Professionals expect that. Let's lock this in. Markets don't pay you for predicting candles. They pay you for managing risk when you're uncertain. Most traders train their eyes. Profitable traders train their decisions. Prediction feeds ego. Execution feeds accounts. Stop trying to be right. Start training to be consistent. Now I'm curious, what skill do you think you've been training all this time? Prediction or decision-making? Drop it in the comments.